So let's talk about something exciting then in the form of Associated British Foods, which has reported earnings this week. I mean, most, I think, people know this as kind of Primark and Friends, which is to say this is the company that kind of owns Primark. And Primark is a big part of its sales. It's not all of it. If I was going to guess beforehand at how much of it Primark was, I would have guessed at a bigger number than I was at. I would have said it was probably between sort of 60 and 70% of revenues. It's not. It's about 47%, so just under half of this group's sales are Primark. The rest of it is, well, it comes under a few different categories, which is stuff like grocery, as it calls itself, which is Twinings and the like, which I view as some kind of, well, I don't have a great eye for this, as my comments on Unilever have shown in the past, but branded stuff that I don't really care about on the branded side. I have not really gone hunting down Twinings as a brand, and the same goes for pretty much everything else that's in their grocery portfolio. Ingredients is another part of it. Sorry, grocery is 21% revenues. Ingredients is stuff like baking yeast and flour, and again, don't hugely care. Flour might be one where some people care. My wife has got back to doing the sourdough stuff that she was doing in COVID lockdowns because everyone was. And maybe there's something about fancy flour there, but I'm not entirely sure that's much more than a commodity. Sugar, which is definitely a commodity. They own Silver Spoon, and I would absolutely not pay more for sugar because it came from Silver Spoon than from, I don't know, Tesco or anything else. And they also have an agriculture arm, which is to do with animal feed, basically. So ingredients are 11%, sugar 13%, agriculture 8%. And I think, by the way, ingredients and sugar have just swapped round in terms of which order they're in. So nothing in this company is growing particularly quickly, and that's bad. So the stock has kind of fallen back a little bit. The big thing, I guess, that people keep their eye on, and rightly so, is Primark. My sort of general view of this, and I've had this view for a while, is I would be interested in buying this stock when I thought it was worth it for Primark by itself. If you gave me all the rest of the stuff for free for the time being, then I might be sort of interested in this because Primark, I do understand. I do think it's a good operation. It doesn't do online, as a thing we've talked about from the last 4 years or so, of course, doesn't have an e-commerce arm. And to some extent, that's been a very, very good move for them. So you don't need to look too far to find companies like Nike, like Doc Martens and so on, shifting into online retail and getting into trouble in online retail because warehousing is expensive, this kind of distribution is hard. An issue that we don't mention a huge amount for them, but matters an awful lot to Primark in terms of trying to compete with the likes of, in the same sort of territory as the Boohoo's and the ASOS's of this world, is that returns are a real killer, as far as I can tell, in that kind of industry. People send stuff out that gets returned. By the time you've kind of restocked it and racked it again, you're basically going to make a loss on that, having covered the postage both ways. So Primark, of course, manages to avoid all of this stuff. The kind of downside is that people do have to go into their stores, but people do go into their stores. So it's 47% of sales and 56% of profits, and it grew at a mighty 2% in their last trading update, which is not strong, especially for an organisation that is growing its store count. You would expect better than that. The kind of big culprit of this was, here in the UK, which is 45% of total Primark sales, so 45% of 47%. So you're looking at just under a quarter of the whole thing, and that's down 4%. Like-for-like sales down 6%. They blamed it on a decline in the retail clothing market partly, and they've lost a bit of market share too along the way. That's about as bad as you could expect a report to be, I think, for the UK. The store count there has been sort of largely flat, but this was highly unencouraging, at least in the short term anyway. They did the standard retailer thing of complaining about the weather, which I suppose does matter if you're trying to sell clothes to people. But stronger in the US, which is, I think, probably the big, interesting opportunity, because I'm always a little bit skeptical of UK companies exporting themselves to the States, and will these things take off? And to be in fairness to these guys, it does look like Primark is making some headway over there in the States. This appears to be genuinely quite strong. Growth was up 17% Sales were up 17%. This is about 5% of Primark's total sales. They opened 2 new stores, taking them to a total of, I think, 29, with 17 more at least to follow. To me, this looks like there's an awful lot of room for US growth here. 29 stores in the States is you could probably fit a few more in without cluttering up the landscape too much with Primarks everywhere. They're also good in other countries, which they lump together in sort of interesting ways. So Spain and Portugal, they view as a region. Italy and France, they view as a region. Central Europe, they view as a region. The stock is down 3% today, 5% this week on all of those areas growing pretty well, but the UK taking up so much of Primark's sales, this being fairly weak on that regard. And realistically, Steve, I think a lot of people are going to have the same-ish view that I have of this is a proxy for Primark. I don't care. You can tell me as much as you like about Twinings tea bags. This thing is a proxy for Primark. Tell me how that company's doing.
Yeah, and that wasn't particularly. If that's what your focus is, then you're not going to be very impressed with large portions of this report. So they said mid single digit growth guidance and revised it down to low single digit growth for the fashion outfit. They said that the trading activity within elements of their shopper base was weak as a result of cautious consumer sentiment and a lack of seasonal purchasing catalyst given the mild autumn weather. So not enough people buying coats, and it rained too much. Yeah, and then the total sales up 2%, 3.3 billion in the 16 weeks, but most of that looks to be new store openings. Like for like sales, though, Steve, declined 1.9% in the same period. That's not great. The fashion chains like for like sales in just UK and Ireland, which is half of the total, fell by 6% over the 16 weeks, and their share of the UK fashion market has slipped 6.8%. So the problem I think that you have here, Steve, is that Primark think it was the weather and the fact that it was not cold enough. But actually, what it seems to be is that people didn't go to Primark in the UK and Ireland. And that's discussed a little bit later on. There's an analyst here from Global Data that said that essentially 2025 looks to be a challenging year for retail. They think that consumers still remain uncertain of economic outlook. So Primark's got to try and focus on this value for money credentials alongside affordability. But interestingly here, Global Data have highlighted women's wear as the weak link. And they said this is because women have more scope to cut back on high volume purchases during inflationary pressures. And apparently women, Steve, are increasingly turning towards resale. So, this is quite an eye-opening piece of report here, and the analysts' take as well. Quite interesting. It shows that perhaps not everything is as rosy at Primark as they're trying to. I don't think they're trying to lead you on to saying everything's rosy, but they're trying to sort of cover the cracks of what could potentially be a bigger issue. They're saying mild autumn weather and cautious consumer sentiment, but that doesn't seem to be the case everywhere else. So. Yeah, I'm interested in this one, Steve. I don't think I'd be in a rush to go out and buy it if this was a stock I own. I think I'd need to see a couple more quarters to see some improvement. But yeah, I think there's just enough in there to keep you interested, but the vast majority of that is not particularly great, Steve.
Very quickly, before we come back to this in a moment, where are you at on Greggs at the moment?
Yeah, Greggs you're going to tell me Greggs is pretty similar, aren't you? Haven't bought Greggs, but it's on my watch list at the moment.
I'm not going to tell you it's similar per se. It's a much more. They're different in the following ways. This is a more complicated outfit, right? This is Primark plus a load of noise that you have to try and work past, or at least that's how I kind of view it here. I wouldn't mind seeing them spinning a lot of these kind of divisions if they thought they could sell them to anybody. But both of them are reporting. Primark, here's the following difference. Greggs, I think the issue with them is that their growth is limited by the number of stores they can open without trying something quite radically different. I don't actually think that's true of Primark. I think they have quite a bit of room to keep opening stores for the time being, especially since they have a foothold in the States, and that looks pretty good. What you can't put up with is like-for-like sales going backwards for very long, which Greggs is not doing, and Primark is for the time being. And I had a look. So there are 13.7 billion market cap for ABF, the whole thing here. A couple more in net debt. So add that on too, takes you to 15.7. Primark last year was 1.1 billion in operating income, which takes you to call it 15 times or so. That's why I asked you about where you were at on Greg's for the moment. So Greg's is also about 15 times. That's 15 times net income, to be fair, and this is 15 times operating. They're very different kinds of organizations here, right? This gives you a bit more, dare I say it, diversification, although I'm not sure I would view diversifying into animal feed as the way I want to sort out my kind of uh, risk of concentration in Primark. But I sort of wonder in this case of there might be a question of thinking about which one I prefer out of these rather than thinking that they're similar. I think they're quite different in a number of ways, but working out which one might be the more promising option is a little unclear to me, I think.
I think Primark probably is going to get hit harder than Greg's with this minimum wage increase as well, though I would assume. I think they're going to get a lot of people in that kind of area. I think Greg's is they pay more than the national living wage anyway for everybody, as far as I'm aware. So I don't think they'll get, they're not going to get hit by this minimum wage increase. Whereas I can't imagine Primark do. I think it's kind of in their nature. I'm sure we'll be somebody will be in the comments and let us know we're wrong on that. But my assumption would be that Primark doesn't. I would assume it gets quite a lot of seasonal sort of, short term workers to especially to meet things like short term demand and things like that. So I don't know whether they do. I couldn't imagine that they do. So I wonder just how that operating income looks in the face of these rising costs across the board. But I mean, like I said previously, I think it was on JKR's show actually. These costs are coming to pretty much everybody who pays the minimum wage or not. So it'll be interesting to see where everybody is this time next year, Steve. But trying not to let fear get hold of you when it comes to these kind of UK stocks, Steve, because they've started off very well this year. And I wonder just how it continues when these costs start to bite.
Yeah, Greg's hasn't. Greg's started the year really badly. Greg's is down 27%. But trading results have been kind of okay so far. It feels like there is something still to follow here, and it'll be interesting to see partly how that grips on and partly what the Chancellor does. That's another segment for another day, though. I think I was listening to something on that a little bit earlier. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.